Today, I'm just going to talk you through our main methodology that we use at Robot Mascot and share the insights that we've developed over the last 3 to 4 years with intensive research with investors and founders to find out kind of what makes them tick and how you go about creating some investment materials that really help you convince investors that your business is the one to back, put you in the top few percent of founders that are raising investment. So I'll start just by introducing Robot Mascot and why we have developed this methodology and what it achieves for our clients, to give you a bit of context. So at Robot Mascot, we create investment materials that convince investors. That's either business plans, financial projections, or pitch decks, or a combination of all of those things for our clients. And when we do that, our clients become 30 times more likely to raise the investment that they need. And a lot of that is down to the methodology that I'm going to share with you today. Those types of results have led us to being recognized as the UK's leading pitch agency. And we're trusted by the likes of Crowdcube, Seeders, the Global Accelerator, Dent, as well as a number of other partners and incubators such as Seed Legals and the Social Tech Trust, to deliver this work for their clients. And essentially, at the heart of Robot Mascot, what we really believe in is that when great innovation meets inspiring communication, really incredible things happen. It has the power to change the world, create movements, and raise investment. And we really got fed up of seeing loads of great ideas fail because of poor communication. And that's how Robot Mascot formed. And that was either because they were failing to convince clients to buy their products, or they were failing to convince investors to buy their equity. And over the years, we've really refined our approach to helping founders convince investors. And that's really what we do now. That represents the majority of the work that we do with our clients, is helping them with investor communications. So I want to kick things off just by proposing to you that despite of everything that's going on, now is a really great time to be raising investment. In fact, there's probably never been a better time to raise investment for your business than right now. So if we just look at the value of equity deals over time, between 2015 and 2019, so the last full 5 years, we've seen a 200% growth in the value of equity deals. That's massive, from 4 billion to 12 billion in 5 years. So there's been a massive spike post 2016. And we can probably all remember what happened in 2016. So suddenly there was a big shift in the markets, in the economy. There was the Brexit referendum around that time, and I don't know if it's a coincidence. I believe it's not. For what I'm going to show you later, that shock meant something was happening. It meant that people were changing the way they were thinking, and we suddenly saw this massive spike in the number of equity deals. And incidentally, the latest figures for the first half of 2020 are actually seeing that the amount of investment that's happening is matching the last half of 2019. So the last half of 2019 saw 5 billion of investment, and half one of 2020 was exactly the same. So despite all of what was happening through lockdown, all of the doom and gloom and the scaremongering, we're actually seeing, not a growth, but a consistent kind of pattern with the investment. So I just want to draw your attention to the fact that, think how much, how established equity investment is now in the economy, and especially for the last 3 years. And any shock to the market that's coming, any recession that's coming, there's going to have to be a massive change in the amount of investment that's happening to even get anywhere close to 2016 levels, 2015 levels. And we were doing this job back then, and it wasn't considered a particularly difficult time to raise investment in 2016. There was still plenty of activity, and there was a lot of excitement around what the UK was doing in the tech space. So I really don't think that investors are going to be too concerned about what's going on, and I don't think you should as founders seeking investment either. And the reason I say that is because even during a recession, equity deals perform really well. So if we look back at what was happening in 2008, in the 2008 financial crash, we saw a massive rise in the number of deals being done. So year on year, there was growth across both angel and VC deals between 2008 and about 2014. And the reason for that is because when there's a financial crisis, when the stock market isn't performing, investors draw their money out of that stock market. They don't want to invest in their stock market anymore. They don't want to invest in the volatile property market. So they look to put it into businesses instead. And they're looking to find sensible investments in businesses that can see them through that recession, through that kind of 12-month downturn, that two to 3 year recovery, and come out the other side stronger. They've got the wealth. They need to deploy it. It's no good in the bank at really low interest rates. It's no good in the stock market where it's super volatile. So they put it into businesses instead. And we saw in 2008 and 9, we saw investments in companies like Airbnb, Uber, Stripe, WhatsApp, Instagram. In the UK, we saw investments in Zoopla and Brewdog. And obviously they've all turned into unicorns or close to unicorns in that time. And what's happening is these investors are looking for new places to invest money. And I expect that to be exactly the same case. That the same thing happened during the dot-com bubble bursting, and the same thing will happen with this coronavirus recession. Recessions happen every 10 years or so. They're fairly cyclical. You can track the patterns. The same thing happens again and again, and there's some kind of shock. It was obviously the financial crisis in 2008. It will be COVID-19 in 2020. And the same thing will happen again. We'll suddenly see a spike in the number of deals being done. What I find really interesting about this particular graph is you can see how steady the number of deals being done have actually been for the last 5 years. The actual number of deals being done is fairly consistent. So despite the fact we're seeing this massive growth in investment that I showed you on the last slide between 2015 and 2019, the actual number of deals being done has remained fairly static. So while the numbers on the surface can look really good, and it's like, all of this money is being plowed into businesses, and we're, if headlines will say that there's been a 20% dip in the amount of money invested into businesses, what we really want to look at is the number of deals being done. And when you see the number of deals being done, it's been fairly static for the last 5 years, and I don't see that changing. In fact, if anything, I see it going up, just like it did in 2008. And if you look at pre-2008, the same thing was happening. It was a fairly static market. There was a shock to the market. People who were going with safe bets in the FTSE 100 were drawing that money out and started putting it into entrepreneurial businesses like yours. So I think the future is bright for, I've got those slides in twice. The future is bright for those of you seeking investment. But here's the problem. So the average angel sees 10 pitch decks a week. 1 a week is of interest, and they make 2 investments a year. So the average angel is seeing 520 pitch decks every year. They're meeting 52 founders because they look of interest. And of those 52 founders, they're making just 2 investments. And those investments tend to average, if you look at the British Business Bank averages, they average about £20,000. So if you're looking for £100,000 SCIS raise, you need to be one of those 2 investments 5 times over with 5 different angel investors. That's over 2,500 pitch decks that will be seen, and yours needs to be selected 5 times. It's the same case with VCs. They invest in about 1 in every 150 deals they see. So the chances of actually securing funding are pretty low. So less than 1% of businesses actually successfully raise and are funded by angels and VCs combined. So less than 1%. That's a pretty surprising figure for lots of people. And I'm going to explain to you, I'm going to give you the formula today to make sure you're in that top 1%, or you're at least in the top 3%, and you've got giving yourself a fighting chance. It all comes down to your pitch. Okay, so the pitch is the key that unlocks the safe. It's the thing that gains you access to the capital. And a lot, the pitch is the thing that opens the door. It allows you to have those meaningful conversations with investors and have a deal done. It gets you as to one of those 52 meetings, and then you need those other assets that I mentioned, the financial projections and the business plan, to be able to impress the investor in that meeting and become one of the two deals that are done by them in a year. But the pitch is the key that opens the door. Without that, you're not going to be able to have those meaningful conversations. And when you think about it, it's actually more like you're in a race for that key against 100 of your peers. If there's a 1% success rate, it's actually much more like you're in front of this safe full of cash, and there's 100 of your peers around you, and you're all in a race to the key that opens the door. So every time you send your pitch off to an investor, every time you go to a pitch event, you're actually up against 100 other people, all fighting for the same key and the access to the same safe. And it's only the business in the best shape that's going to get access to that capital. So ultimately, it's not actually the idea that raises investment, it's the communication that does. So investors really don't care about your idea, they care about the investment opportunity. And if you can prove that you can commercialize your idea and you can make a success out of it and it can bring a return on investment, then investors are interested. So it's not great ideas that are raising investment, it's the great communication that is. And it's not just me who says that. Over 80% of investors that I've interviewed agree with that sentiment, and they all say that it's the communication that ultimately decides whether they invest in or not. And it's the communication of two things, really. It's either the communication of your vision, so they can buy into your vision and get excited about what you're trying to achieve, or it's the communication of your strategy. And if you can't communicate both of those things, if you can't inspire people to join you on your vision, and you can't communicate your strategy for success, how you're going to create commercial success out of your idea, then an investor isn't going to be interested. So far too many great ideas are failing because of poor communication. And that's because they're poor at articulating their idea, they're poor at explaining their business case, and often there's just key information missing for investors. So entrepreneurs are really good at talking about opportunities and possibilities and ideas and kind of the big picture. Investors want to see kind of what's the underlying assets in the business, what's the implementation plan, how are we going to what are the stepping stones from A to B, what does my exit look like, what's the return I'm going to get. So you're almost talking two different languages, and you're not giving the information that investors need to be able to make a decision, and you're not ticking their boxes. And because of that, you're getting the zombie stare. When you pitch your idea and you just get that blank glazed over look, because no one understands what it is what you're pitching. They don't understand your vision, they don't understand what you do, and they don't understand how you're going to turn this into commercial success. And I'm sure we've all been in a situation where we've received a look like this from either some bloke down the pub who asked you what you do and you try to explain your business, or some of you may have got this look from an investor, unfortunately. So this is the solution. This is our methodology. This is what we do with our clients to make sure that they achieve that cut through and that they communicate properly to investors. And we call it the 6 principles of the perfect pitch. And it's what I'm going to take you through today. So there are 3 key phases within this methodology. And the first is the preparation phase, and it contains the first two principles, plan and projections. Really, the preparation phase is all about ensuring that the business plan meets with investor expectations and holds up to scrutiny. So it's all about, before you jump into trying to create a pitch, do you actually have a business case that shows that you can create commercial success out of the idea? And do you have a set of projections that show the financial risks and the financial rewards on offer? And is that return the type of return that an investor is looking for? And does it stack up against other deals that they're seeing? So remember that you are one of over 100 different founders that they'll be looking at to source a deal. And your offer, your potential return has to match up and has to stack up against the rest of the market. So it's making sure that you do all the preparation properly and you get those underlying assets in place. There's no good trying to build a pitch without first getting the preparation in place and having it built upon a credible plan and a credible set of projections. The second phase is then the construction phase. And this is where you take all that information, this sort of 30, 40 page business plan, and you start to work the content down into 15 to 20 articulate slides. It's where you produce the clear, compelling, and logical narrative that you're going to deliver to investors. And it consists of the structure, the content, and the clarity phases. And we'll talk about those in more detail. And then finally, the final stage of the process is the create phase, and that contains the sixth principle, which is design. And this is where you're going to create a professional looking presentation that builds trust and authority to an investor. Now, what a lot of founders will do is they'll start at principle 6. They'll have had their business idea. They've got a load of ideas in their head about how they're going to commercialize it. And they open PowerPoint and they sit down with Google next to them, having Googled what slides should I have in my pitch deck. And then they try and create something from a blank sheet of paper. And they're missing out this process, and they're missing out this refining of information and refining of the narrative. And that's ultimately what's leading to them unable to properly communicate, because you're trying to make it up as you design it. You're kind of making it up in the PowerPoint document. You've suddenly read you need a slide on market research, and you're suddenly fumbling around trying to find some market research, having never done it before. So by following this process, you make sure you're going through this logical process of what's my overall strategy, how do I create success, and how am I going to refine this down into a clear and compelling piece of communication. So let's kick things off with the first principle, the plan, the business plan. So this is by far the most important place to start. It's all of your thinking, all of your strategy, all of your kind of IP in one place, so you can see it and look at it and make sure that everything's consistent and credible, and get everything down in one place, so then you can figure out what are the most important things that you need to communicate to an investor. By having the plan in place, it tells investors that you have the strategic steps to actually turn the idea into something viable and something that can actually generate a return and generate revenue. So it's the basis for the content for a brilliant pitch. If you don't do this work first, your pitch isn't going to feel credible. It's going to feel kind of made up on the fly. It's going to be a little bit kind of all over the place. It's not going to match up, and it's not going to feel consistent, and it's not going to feel credible. So it's kind of no different for them buying anything else. When you spend money on something of value, so these investors are buying your equity. When you go and buy something of high value in a store online, you need to make sure that certain things are in place. And I noticed this happening when my father-in-law was buying a classic car recently. So he's a massive fan of classic cars, and I often accompany him to some auctions. And I realized that he was going through exactly the same process that investors are going through when they're assessing your business deal. The first thing he was doing is making sure it was searching online ahead of the auction to get a short list of the cars that he wanted to look at and the ones that he wanted to potentially bid on. What he was doing is looking that there was correct information on that, on those listings, that gave him a good sense that this is a good car to invest in. This is the type of thing that he's looking for. It's the right age, the right model. It's got the right documentation. It's got the right service history. All of the information that was on that online portal. Now, some owners of cars had listed their car and not bothered filling in a great amount of detail, and he didn't even bother adding those to the shortlist because it would be a waste of his time. So this is exactly the same when you have pitch to an investor and it hasn't got the correct information in it. If you haven't got the correct information in it, it's not ticking their shortlist. They've got a checklist sitting there and they're checking that you've got everything there that they want to see. If you haven't got it, you're instantly discarded. They're not going to take you through to the next stage. The next thing my father-in-law did was to check that the information that he was presented online was actually consistent with the car that he was seeing in real life. So the first thing we did as soon as we went to the auction was make a beeline for all of the lot numbers that he was interested in. And he started going around the car and he was lifting up the carpet in the boot, because that's apparently where a car is most likely to rust. A classic car is most likely to rust first. He was tapping around the bodywork of the car. And I learned that it's that's for checking for filler. And if you're interested, it's a donk if there's filler, and there's a dink if it's not, just in case you're thinking of buying a classic car in future. So I learned that. But he was essentially checking that the car itself matched up with the information he was presented. And this is what investors are going to do as soon as they see your pitch. They've seen you've got the correct information. The next thing they're going to do is they're going to start checking that it's consistent. They're going to want to see your financial projections, and they're going to want to see your business plan, and they're going to want to see that this is consistent with what you've told them in the pitch. What a lot of founders will do is they'll create their pitch and they'll update bits and pieces of their pitch, and they'll never update their financial projections. They'll never update their business plan. And all of a sudden there's inconsistencies and the investor isn't quite sure what you're planning to achieve. The final thing my father-in-law was looking for before he decided to bid on one of the cars was the provenance of the car. He was checking for its credibility. What's its history? Are there replacement parts original, or are they genuine? How many owners has it had in the past? And this is very similar to what an investor is going to be doing. They're looking for your credibility as a founder. What have you done in the past? What experience do you have? What insights do you have to make this business a reality? And once they've understood all of those things, once they've understood that you have the correct information, you're consistent, and that you're credible, they're then going to think about investing in you. So if you don't have all of this stuff ahead of your pitch, ahead of creating your pitch, there's absolutely no way you're going to be able to create a pitch that investors want to invest in. And even if you did manage to create a pitch that they want to have a further meeting with you, you're going to come unstuck as soon as you start having serious conversations, because you're not going to come across as credible, and you're not going to come across as consistent. So you'll essentially be leaving the wrong impression with the investor. And so before you even think about pitching, get your plan right and get your plan in place. The second principle is the projections. So it's a vital component of the pitch. You're going to need to show your 3 to 5 year projections at some point within your pitch, so investors can see kind of what their return is, what their reward is going to be. But it also gives them a sense of kind of how realistic and how credible you are, because if they're crazy projections for the type of market that you're in, then they're going to know that you're perhaps not as credible as they're hoping. So the projections are really looking to demonstrate to investors that you understand there's a financial risk involved. You understand you're asking them for money, but you're also going to demonstrate to them, you know, exactly how and where and when you're going to spend that money, and what return it's going to get, what position you're going to be in once you've spent their money, and how that's going to have an impact on the long-term growth of the company, and therefore what their shares and their will be worth at the time of exit. So when it comes to your projections, you should be looking for 3 things, and you should be sense checking your projections against 3 things. And again, if you don't have these 3 things, they're probably not going to be the type of business that most investors are looking to invest in. So the first thing you need is growth. You need to show large growth. So we're talking kind of 15 to 50 million revenue in. So you need to sort of avoid being conservative. You want to grow to a sizable business with multi-million pounds of revenue coming through. If it's less than that, 4 or 5 million revenue, then it's a very specialist type of investor you're looking for, who isn't looking for massive returns. They're out there, but it's more difficult to find those types of investors. The second thing you need to look at is the speed at which you get to that growth target, the speed at which you achieve that revenue. So most investors, especially if you're a tech entrepreneur, they're looking for a 5-year exit. They're not willing to hang around for 20 years to get their money back. So you need to explain to them how you plan to grow your business to from potentially nothing to 50 million revenue in 5 years, with the potential of then exiting the business at that point. And bear in mind that a unicorn business on average takes 7 years to build. So if you're not planning on becoming a unicorn and you're going to take longer than 5 years to build it, an investor might need to know why that's the case. And then finally, you need to show your exit potential. So most angel investors are looking for at least 10, if not 30 times return on their investment. So you need to work out your exit multiple, what your revenue is going to be by the end of year 5, and be able to explain to an investor how you're going to sell the company at 30 times the value in which you are today. If it's less than that, they are unlikely to be interested. If it's less than 10 times, they're unlikely to be interested. Remember, they're getting 520 opportunities come to them every year. They're only needing to pick 2. So you need to stack up both against your strategy for success is believable and actually credible and can work, but also what you're going to deliver off the back of it in terms of a return is exciting enough and high reward enough for them to put in the risk. So you're going to need to make sure that your projections show an EBITDA or a profit that makes it possible to achieve that 10 to 30 times exit valuation. If you're looking for VC investment, it's much tougher. You need to show 150 times return as an absolute minimum, because they invest big in a number of projects. They expect about 1 in 20 of their investments to actually succeed. They expect a couple to break even and the rest to fail. If you've got say a £50 million fund, they're typically putting 10 million aside just for managing the fund, 20 million aside for follow-on investments. We're leaving them 20 million to invest in their portfolio. So if they're going to invest 1 million in 20 companies, and they're only expecting one of those companies to succeed, they need that 1 million to pay back the other 19 million that they've invested, the 20 million they've put into follow-on investments, and the 10 million for the fund. And it needs to pay back the fund at a 3x return. So they're actually looking for 150 million off of that 50 million as a return off of that 50 million fund. So if you're the one company that they're putting their hopes and dreams on, you need to show at least 150x. So if you're every single one of those 20 companies that they'll have invested in for their portfolio has the potential of achieving 150x, knowing that just one will. So it's high stakes, high failure. They're not looking for a nice little portfolio of 20 companies that all do okay. Unlike an investor, which is an angel investor, where they're happy with lower returns because they tend to look for slightly more modest returns with a slightly lower risk. The VCs are looking for that big exit, that 150x return but they're only expecting one company out of their portfolio to actually achieve that. So growth, speed, and exit. You need to consider all these things before you even think about starting to write your pitch. But once you've done those things, you've completed the preparation phase of the 6 principles of the perfect pitch. So once we've completed this work, we move on to the next phase, and the first principle of that phase, of phase 2, is structure. So the structure is really about considering how we tell the story, not what we want to say, but the order in which we say it. So the structure is the underlying narrative, the order of the communication. It's really like creating a university course. So if I was to create a new physics degree, for example, it's unlikely that I'm going to start semester 1, lesson 1 with string theory. one of the, you know, the most complex theory there probably is in physics. I'm going to build your knowledge up to that, and by the end of year 3, I might hope that you can comprehend string theory. I'm certainly not going to expect you to understand it as a fresher. So what I'll be doing is building up a course lesson by lesson to unpack knowledge and deliver knowledge in an order and an information in which you can learn and understand. And that's exactly what you're trying to do with an investor with your pitch. Think about it this way: 80% of investors define themselves as sector agnostic. So while you may be an expert in your sector, they're not. So they've never come across your business before. So they don't know what you do, product you have, or what problem you're trying to solve. So you've got to explain everything about your business, but you've also got to explain everything about your sector and why it's a great sector to be building a business in, why there's a great opportunity, how you're going to leverage that opportunity, and why they should invest in it. So your job is doubly difficult. Not only do you need to have them understand your brilliant idea in a way that they can comprehend, when you've probably got some complicated methodology or some complicated technology to explain, you also need to help them understand the whole kind of wider sector or the wider vertical in which you're operating in, because they're probably not specialists in it, because they're probably sector agnostic. They're looking for a great deal. They're not necessarily specialists in your sector. So you've got to build the story in a way that makes sense. And we think of it as taking an investor on a journey of discovery. A journey of discovery, discovering your sector, discovering your business model, discovering your concept, discovering who your customers are and why they've got certain problems to solve. And we use this method within our 6 principles of the perfect pitch. So this is the method we use specifically for the structure part of the process, and we call it the 5 acts of the perfect pitch. And it follows a structure that's well used and has been for years. It was a narrative structure created by the ancient Greeks for delivering communication by the form of plays and entertainment. And Shakespeare was a massive fan as well. You'll see most of his plays are written in 5 acts. And it was the exposition, the rising action, the climax, the falling action, and the resolution. And that's exactly what we're doing here with your pitch. So as I kind of hinted at earlier on, a lot of founders will sit there and they'll Google what slide should I have in my pitch deck. Now, if you perform that Google search, you'll get millions and millions of results, but you'll also get, if you look at each of the first couple of pages, you'll get 30 plus different types of slide, and you'll have hundreds of, loads of different combinations of those slides. So there's no ready-made hard and fast structure for your pitch, and those that tell you there is are kind of trying to just make it too simple for you, and they're the people that aren't really getting the success. What you need to understand is how to tell a story and what's important to you in your business, because you're supposed to, a good length pitch is 15 to 20 slides. If you're going to have all 30 slides in that Google would suggest you should have, you're going to be saying too much to an investor. They're going to switch off, and you're going to be talking about things that aren't so relevant to you and your business. So we use the same 5-act structure, but we've tailored it for the use of a pitch deck, and it works. So the first is the hook. The first couple of slides really got to hook you in, kind of getting people usually to buy into your vision. It might be that you've had some incredible traction, or you're the trusted provider. Maybe you're a new fintech app and you've just signed a deal with Barclays. That's a massive hook. Or you've got this really powerful, impactful vision that you're trying to achieve, and you're trying to get people to buy into your vision of the way you're going to change the world. But what's that hook? It's the elevator pitch. It's the thing that's going to make people go, wow, these guys sound interesting, I want to read on. Then you move into the essence phase, and this is where you really start to unpack your business concept. So we're not talking about strategy, we're just selling them in on the concept. What do you do? Why do you do it? Who is it for? What problems is it solving? What's the essence of the business? Try and keep it as simple as you can. Keep it to 4 or 5 slides. What benefits are there? All of those types of things. Then you move on to the evidence. So this is the climax of the narrative. This is the bit that after they've gone, wow, these guys sound interesting, I want to find more. Okay, I get what the product is and how it works and who it's for and what problems it's solving. This is the bit that's going to make them go, shit, these guys have got something. So this is the evidence. This is the traction and the validation. This is the stuff that investors are talking about day in, day out. What's your traction? What's your validation? How do I know this is a good idea? Yeah, you've had that problem, so you've created this product, or you've seen a friend or a colleague have this problem, so you've decided to create this product. But how do I know there's a market big enough and there's other people with this problem? How have you validated that? So pushing out a survey to 20 people isn't really going to give you much evidence. And isn't going to give you much of a climax to your pitch. But if you've got hundreds of people responding to a survey saying that they want your product and the features and they would pay for it, if you actually got some traction, you've built an MVP and you have signed up users, then you've got a great piece of evidence. If you've got partnerships or testimonials from people within your sector and your niche, should say, or your potential customers saying this is something that I would buy, or as soon as the MVP is launched, you've kind of got a contract in principle for them to push this out to their clients. All of that stuff is evidence. You want to really build press and PR you might have achieved, just anything that you can do to kind of give yourself authority and say, I've got the insights, I've got the traction, and I've got the validation to make this work, and I understand this better than anyone else, and we're actually going to make this happen. Once you've kind of sold them in on the concept and they see that there's a market opportunity for it, it's then about telling them how you're going to make it happen. How are you going to get to these people, and how are you going to actually scale your business, and what money on. So you then come to the plan elements, and this is why it's so important to have the preparation phase complete, because this is where you're going to be talking about your marketing strategy, which, by the way, is absolutely vital. Far too many founders I see have just a bullet pointed list of some activities that they might do, like, oh yeah, when we get funding, we're going to do some social media ads. How much are you going to spend on those? Oh, I don't know, a few grand. Okay, what's your cost per acquisition going to be? Oh, I don't know. What's the average cost per acquisition of Facebook? Like, have some detail, have some meat on the bone. Investors know that after capital, the biggest failure of startups is their lack of ability to sell their product. So it doesn't matter how much investment you get to make the thing. If you can't sell it, you're not going to have a successful business. So you've got to be able to detail your go-to-market strategy or your scale, your growth strategy. Otherwise, you're going to fall down. Investors are going to know that there's a big gap that needs to be filled in your business. You'll be talking about things, obviously, your financial projections. You'll be looking at things like your market opportunity. All of this great strategic kind of stepping stones that you're going to be putting in place to actually make this a success. What partnership opportunities are there? What growth hacking strategies are you putting in place? All of this stuff is information that you want to have in a pitch. And again, it's, you keep it to 4 to 5 slides, no more than that. And then finally, it's the ask. And it bamboozles me how many times founders forget to actually ask for money after they've pitched. Like, this is a sales gig at the end of the day. You're trying to sell equity in your business. You wouldn't go into a room and try and sell your product and not tell someone what the price is and what they're going to get in return. So you've got to have an ask. You've got to say, this is how much I'm raising. If you've got a clear valuation and you've got a commitment from some investors and you've set the price of the round and you know how much equity you're giving away, you want to tell them what they're going to get in return for the business. And you want to paint a picture of the exit. You want to say, we're going to exit to these people and these types of companies, and we're expecting a certain return on investment, and that's what the day of exit looks like. And something that we always include and we always make sure our clients have, because we think it's really transparent and it positions you as this kind of investable entrepreneur and someone that they can actually work with, is just to be really clear on your key objectives for their money. So you're going to raise, I don't know, let's say 500K for your business, and there's some key strategic milestones that you're going to meet with that money. It might be launch to market, create the proof of concept, achieve X number of users, and then do a big launch and prepare yourself for a big launch to market where you're going to raise another round of funding to make that happen. detail how many users you're going to have, detail the month of the year that you're going to have your proof of concept built. Make them kind of smart objectives that you can be held account to. If you're saying, you're just subconsciously saying to an investor, I'm someone you can work with and I'm someone you can trust with the capital, because I'm being very clear. I'm not just saying I'm going to take your money and spend it on making this great idea a success. I'm saying I'm going to achieve these key things and I'm going to do them in this time frame, and I'm going to get this number of users. And once I've got this number of users, I'll be then raising another round of investment so we can do a big launch to market and implement our growth strategy. So whatever those key objectives are, just pick 3 or 4 key strategic objectives and just be really clear and open and honest, and explain how you're going to spend the money and what it's going to achieve. So that's the structure. Kind of at this point, you're not writing any content. You're literally just sitting there and going, right, what's the most relevant stuff that I should talk about in my hook? What do I need to talk about in my essence? I need to talk about what the product is, why we do what we do, who it's for, and so on and so forth. So you're just mapping out the key pieces of information that are most relevant to your business. And then you come on to writing the content. So the content needs to be clear, concise, and articulate. You should be no more than 75 words per slide. Ideally, you're looking at 50 words. And this is for the full investor pitch. This is the pitch you're going to send to an investor so they can read on their own. Obviously, if it's a presentation pitch like this is a presentation, you're going to want as fewer words as possible on a slide, like just the word content, because you don't want them focusing on reading the content on the slide. You want them to focus on you, the entrepreneur, in which they're putting all of their faith and money in. So they want to get to know you. You want to come across as knowledgeable and give your own interpretation of the key information that you want on the slide. So it will often be just a few bullet points when it's a presentation pitch, but when it's the full investor pitch, you're wanting 50 words, no more than 75 words per slide. So how do you condense a 40-page business plan into just a few slides of 50 words each? Well, we've created the setup and score format. This is the format we use that delivers really powerful and engaging communication. So it's a bit like playing volleyball. The first thing you're going to do is set up the shot so that you can smash it home with some amazing and win a point. So each slide needs a setup, and the setup is the engaging headline. So what a lot of founders will do is they'll have a slide, and the slide will be titled "Our Solution." Great, but it's not very engaging. I don't really learn anything from that. Remember, you're getting as fewer words as possible on this slide, so it's engaging and it has cut through with the investor. So our solution isn't going to cut it. That descriptor, that headline should be a descriptor, an engaging headline of what your solution is going to achieve, what the end result is. And it's the same throughout most, especially in that. This is particularly useful in that essence part and the hook part, the evidence part as well. In the plan, you can start to just say market opportunity and that kind of thing. But this first half of the deck, where you're really trying to sell people in, you want these engaging setup headlines, so it becomes something meaningful. And then you want to smash home the point with some snappy piece of content that sums up what you're trying to achieve. So it might be just one sentence or 2 sentences that really get the point across. Or it might be 3 or 4 bullet points that so one setup can score multiple times, and you have 3 or 4 bullet points that just kind of go this, and this. And then you're like, wow, okay, this sounds incredible. So here's what I mean by that. So here's an example of a pitch we created for a company recently. The headline sets it up and the copy drives home the point. So we don't say our solution, we say it's a personalized health management and monitoring. Using AI and machine learning, Purdoc derives powerful insights from clinical and patient-generated data to enable better disease management. So one sentence set up with an engaging headline. Here's another example where a solution slide has been used to create score multiple times. So automated savings that grow as you spend, auto save spare cash automatically each week. Money finding, save on bills with automated searches and switching. Auto cashback, automatically receive cashback on purchases. So set up, score. Very, very, very simple, very, very effective way of thinking about your communication. It means you don't waffle. Founders love to talk a lot. about what they do. It forces you to think about stuff in a really clear, concise and articulate way. Then the final part is of the content phase is clarity. And this is where we're really looking to refine the content and give ultimate clarity to it. So it's unlikely that, and I'll be honest, that isn't the first version of the copy that our team produced for that particular slide. We refined it. We went through this clarity phase. And the clarity phase is then you get that rough shape of the copy. We're going to have this set up and score multiple times, and then you get it down on paper, and then you go through a refinement of that content to get it as sharp and crisp as I just presented to you. So it's kind of like panning for gold. You're removing all the silt so that you're left with the golden nuggets of communication. So often you can do this yourself. A really obvious way to check whether or not your content is clear is when it comes to the design phase. You start putting words in bold, or you start putting parts of sentences in bold. If you're bolding words, please stop it. It means that you're not clear enough. You shouldn't need to just pick out a couple of bold or underlined words to bring attention to them. It probably means there's too much content on the slide and you're struggling with the clarity. So you're trying to remove all the silt to be left just with those golden nuggets. You can ask people for their feedback. Is this clear? But be really careful, because it can have the opposite effect. We find it's much better if you just trust in yourself than actually ask too many people. They ask all friends who are founders, and they'll all have 100 different opinions. They're not communication experts. They don't know everything about your business either. Ask investors, and again, they're not communication experts, so they'll give you some feedback, but you'll have to pick and choose whether or not that feedback is right. And actually, investors tend to hate being asked for feedback on people's pitches. So that's one surefire way never to receive investment from an investor, is ask them for feedback on your pitch. So if you get too many people's opinions on your pitch, it can actually lead to a lack of clarity. So once you've decided what your pitch is going to be, I would just stick with it. If people don't get it, they're never going to get it if you've done it right. And if you end up taking all of this feedback every time that you pitch your idea, and you start going, oh shit, I should have mentioned that, I'll put that in there. A question, if an investor asks you a question, it doesn't mean that you didn't have the right content in your pitch. It just meant that you engaged them enough to actually want to converse with you and open a conversation. If you were to then start adding all of these things to your pitch because an investor asked a question, you're going to end up with a muddy and confused pitch again, and you're going to be back where you started. So make sure that you're confident in yourself and confident in your communication, and that you've just refined that content down as much as possible. And then finally, we come on to the final create phase. Once you've written that content and it's all in kind of Word document form at this point, or at least it is when we create it for our clients, there's no design elements. We're focusing just on the language, just on the communication. It's the design. It's the last phase. It's 1/6 of the process of creating a great pitch, but it's by no means less important. In fact, it's the design that's the first thing an investor is going to see. It's the thing that's actually going to give them a sense of whether or not this is an interesting company, or a company that they can be bothered to spend their time on. So they'll decide pretty much whether or not they want to read your pitch within the first 4 seconds or so of opening it. And here's why. As humans, we've been able to communicate visually longer than we've been able to speak. So our prehistoric Paleolithic cavemen would communicate not just what they saw, but they were also capable of communicating thoughts, feelings, and ideas on paintings in cave walls. We couldn't speak, but we could communicate with signs and symbols, and we could try and express what we felt through visual communication. And that's meant that as we've evolved, we can actually digest visual information 60,000 times faster than text. 60,000 times. And there's a really, when you think about it, it's actually not that surprising, because if I was to ask you to think of the last photo you saw on Facebook or something, you'd probably be able to recall that photo, or if I asked you to recall one of your favorite family photos, you'd be able to recall that photo, and you'd be able to describe it at length, what you were wearing, how people in that photo were feeling, where you were, what the weather was like, what was in the background, what was in the foreground, who you were with. You would be able to recall all of that information just from one photo. But imagine how many words it would take to describe the full detail of that image. It would take hundreds of thousands of words in most cases. So it's not actually that surprising that we can digest visual information. At just a glance, we can quickly tell whether someone's happy or sad or angry. But it would take a number of words to explain that to someone. So it's actually a really powerful tool for getting your message across to an investor. If you get the right design, you're going to be able to bypass their natural instinct of fight or flight. They've got this natural instinct of, we've all got it built into us. Before, everything's a danger to us until it can be proved otherwise. You're just some random person who's just landed in their inbox asking them for £500,000. Chances are they probably think you're a danger to them and their wealth until you prove otherwise. So if you open up a really terrible looking pitch that is just sort of black and white text on a white slide with loads of really small copy, they're certainly not going to think of you as an inspiring business that they want to engage with. So by having that professional design, it can completely change your fortunes. It productizes your idea as well. If you haven't got a physical prototype or anything of your idea yet, a great pitch, a great design kind of productizes it in the mind of the investor. It kind of makes it tangible. It makes it real in some way. It kind of changes it from just a concept into something real and something that they can invest in. So they're the 6 phases. It's probably a lot more work than you thought it was, creating a great pitch that actually raises investment. But when you get this right, when you go through all of those phases and you get this right, you end up 30 times more likely to raise investment. You end up in the top 3% of founders seeking investment, which is a massive boost from being 1 of 100. So that means that every time you pitch your idea, you're going to get some kind of interest. It might be interest from an investor. It might be, if that investor isn't interested because it's not the right investment for them, if you've proven that you've prepared in the right way, that you're great at selling in your vision, then they're going to introduce you to people who might be interested. You're going to be able to inspire team members to join you from, quit their corporate jobs and join you on your vision and join you on your journey. A powerful pitch has the opportunity to really open doors, not just with investors, but with potential corporate partnerships, with talent, with all kinds of things. So getting that right is a fundamental skill for an entrepreneur to learn. So that kind of brings us to the end. I hope you've got a lot from today's session. Just a final couple of things from me is, if you would like, you can visit pitchready.co.uk and we have a completely free tool that will give you a 12-page report that will essentially benchmark your ability to raise investment. It will score you across the 3 key components we mentioned: your business plan, your financial projections, and your pitch. There's about 30 questions, yes or no questions. It takes less than 5 minutes to complete, and you'll get a free 12-page report with tips, advice, suggestions, reinforcing some of the things that I've spoken about to you today. And that'll be emailed to your inbox, and you can hopefully pick up some tips and information, and you can visually see where you need to spend time improving your proposition to investors, and where you're actually really strong right now and where you shouldn't be spending your time. And you've already got what you need. So we find that a lot of founders find this a really useful tool. And then finally, we've got a Facebook group called Investable Entrepreneur. I share insights and updates on kind of market trends and what's kind of happening, as well as tips on how to convince investors that your business is the one to back. So it'd be great to see some of you in that group. Try and find us on Facebook and request to join, and that'd be awesome to see you there. And that's everything for me. I've realized that we've got about 2 minutes left. So if anyone's got any very quick questions that they want to throw at me, I'm happy to stick around for the next 5-10 minutes, and you can shout out and I'll do my best to field the responses. Otherwise, it's been an absolute pleasure to have you all here. And yeah, that's me. So anyone got any questions? They just want to unmute themselves and shout out.
James, I just want to say thank you for your time. Very good.
Very welcome.
Victoria, yeah. Very useful, James. Very concise.
Good, thank you.
We'll get on your pitch ready.
Yeah, jump into it. See what score you get. And if you score really highly, we might be able to put you in touch with some investors. So how about that? You score above 80%, it means that you're ready for investment. So we'll see if we can open some doors.
Thank you, James. So we'll be in touch.
Fantastic. Thanks, guys.
Thank you.
Hi, James.
James.
Hey.
Really appreciate it. It was a great insight. Just wondering if this is going to be a recording because I missed the very beginning.
I have recorded it. My plan is to post it into the Investable Entrepreneur Facebook group. So if you want to, I think you can do a video premiere thing. I've never done it before. I'm going to try it. So if you want to jump into that Facebook group, you should hopefully see that video come up if it will let me. If not, I'll try and email it around to people.
Yeah, I'll join the group. Thanks,
fantastic. Man. Cheers.
Hey, James.
Hey. Hey, Shane. Hey. How are you?
Hey, how are you?
I'm very well.
Good. Thank you for that. That was super insightful. I guess my question, slightly away from this, and maybe another topic for you to cover, would be around how to actually approach investment as a whole. So not just the pitch side of things, but actually how do we go about strategizing and building a pipeline of angel investors or VCs or whatever route we want to go down. How do we look at that? And again, it might be another topic for you to cover, I guess, because it's probably opened up.
That's amazing that you've asked that question, because stay tuned. In about 2 months' time, I'll be doing another event. So in a month's time, we've got Seed Legals lined up to hopefully deliver a session around the kind of legal side of doing a deal. Then the month after that, I'm planning on doing an event called How to Make Investors Love You. And that is all about building your pipeline, building your funnel. And actually, once you've got all of this great materials, you've got your investment materials ready, how do you actually go about finding investors? And I'll share some strategies that our clients have used with great effect. And explain the whole kind of, and also how you can make sure that you're raising money in a way that ensures you keep as much of your equity as possible as well, and don't make a mistake by giving away too much equity too soon. So stay tuned for that one. Thanks for letting me plug my next my next thing.
I appreciate it. Thank you.
All right. Cheers.
Hey, James.
Hey, Joey.
I would love to know how y'all charge for your services. Is it a flat fee? Is it a for time? How does it work?
Yeah, it's a flat fee. So we've got three different packages, and there's various different levels of each of those packages. Ranging from kind of a couple of grand up to kind of an $8,000 package. It really depends what you need and what you want. If you want to learn more about that, then ping an email to info@robotmascot, and we'll arrange a call. We might book you. I do every couple of weeks. I do a fundraising strategy session with a small group of kind of 10 to 12 people, much more interactive than something like today. And we kind of talk through these things in a bit more detail and kind of explain to you how we help you create these things through our services as well as part of that. So if you take the scorecard, you'll get a link to book in a strategy session, and maybe that's a good way for us to start, for you to start exploring how that works. If not, just book in email info and our Rebecca, our executive assistant, will book in a call with me, and we can talk through that in a bit more detail. Great stuff. Thanks, Joey. Anyone else?
Yeah, hi James. This is Max.
Hi Max.
Well done. Very interesting. I've learned quite a lot from you. What's really interesting is I actually run a seminar occasionally called the Perfect Pitch, and kind of some overlap, but I was very interested to hear what you had to say. As I said, I've learned quite a lot from this. Now, I don't do it for money. I do it as a mentor to help startup businesses because, as you've rightly identified, the way to raise money is not by having a great business, but having a great pitch. And I see so many great businesses with terrible business plans and pitches. I think you're doing a great job.
Fantastic. Thank you, Max. It is really interesting when you speak to founders, they especially when you're in a co-working incubator kind of accelerator space, there's competition. You're kind of friends, but also enemies, because you're all after the same pot of cash at the end of the day. And you kind of speak to them, they go, how did that guy raise investment? His idea's no way near as good as mine. It's like, because he can tell a story. That's why. Because he can pitch his idea, and he can be believable, and he's done the preparation. His idea may not be so good, and there's some horrible ideas that have received millions of pounds worth of funding, but they're great at pitching, and that's the skill.
Absolutely. And if I can very quickly, I know you want to finish up, very quickly relay a story which hopefully people find interesting. So I was at a pitch event in Monaco last year. There's 7 businesses pitching, and the guy that got the most interest, most exciting, was actually pitching a business related to gold. And after the event, he probably had just about everybody that was in the room interested in talking to him. The best pitch was from a guy, the best business happened to be an American guy. Him and his partner had done multi-billion-dollar exits before. His pitch was absolutely terrible. And people were sitting in the room wondering what the hell he was talking about. And he was probably the most investable guy and didn't get a penny in investment.
Yeah, he had the credentials, but he didn't have the pitch. Yeah, I was talking to someone the other day who contacted Robot Mascot. This is his second business, and he knows from experience how important getting the pitch right is. And he described it as, I've got pitch deck fatigue. I'm just looking at this and I'm wasting so much time going over and over it. I just can't get it right. I know what I'm trying to say, I just can't do it. I need some external help. And people who have been there before and been through that pain kind of normally understand the power of it, but it seems like this guy thought he could do it himself and missed the mark quite considerably.
Absolutely. Well, listen, I'll be very happy to recommend people that we get to you.
Fantastic. Thank you.
Great.
That's great. Well, it'd be great to follow up with a chat. So just email the info@robotmascot.com and we'll arrange a bit of a catch up. I'd love to learn more about what you're doing as well.
Excellent. Will do.
Fantastic.
Cheers.
Thanks, Max. Thanks. Okay. Shall I take one more question and then we'll call it a day if there's anyone else.
That investors are looking for reasons not to invest, as opposed to looking for reasons to invest. As founders, we're expecting everybody wants to give us money, so we're trying to pitch and get out there to them. But but I'm told by investors that's really not what they're doing. They're looking for any reason not to invest. Is that right?
Yeah, absolutely. And that kind of goes back to that initial preparation phase of me saying that they've got that checklist of kind of, if you haven't got the correct information to begin with, it doesn't even matter whether you actually are a good prospect or not. If you don't initially tick those boxes, they're not even going to bother, because they've got so much choice. They don't need to waste their time trying to figure out what's there. If you've got half of the info, you're pitching them half the information and the other half of the information isn't there, but they're really excited by the idea. Then they've got to go and spend a load of time with you drawing out all of the other information that they need. They're not going to spend the time doing it, because there's millions of other people coming their way with a pitch that's got everything they need in it. And that's kind of the approach we take with whether we're writing someone's business plan, producing someone's projections, doing their pitch deck, or all of those things. It's all about presenting the information in a way that it ticks the investors' boxes. So, when you're doing their projections, just having a simple financial summary with all of the key metrics that they're going to be looking for, so they don't have to go through and calculate all that stuff themselves. So even when you get through that initial pitch stage and they kind of go, can I see your projections? You can give them like a 1-page summary that just says, here's the headline stuff I know you're going to need, and here's the full Excel spreadsheets that back it up. Because you don't want to, you want to give them a reason to go, shit, these guys understand us, I can work with this, rather than, you know, I've got this brilliant idea, invest in me. What you'd be silly not to, it's going to change the world, which is kind of the kind of default position of most entrepreneurs. And it's not their fault. I'm exactly the same. I'm an entrepreneur, not an investor. And we're much better at talking about, you know, the thing that excites us is the future and the possibilities and where this is going to go and all of that stuff. And investors want the boring stuff, the implementation strategy, the return on investment, the risk profile. It's like, oh, really? That sucks. That's boring. So
Anthony Rose says, don't make me think.
Yeah, exactly. Just put everything on a plate for them, and it'll be much easier. So it's really understanding the mind of an investor, what questions they want, what boxes they've got to be ticked, and making sure that you tailor your communication for them. It's a very different way than pitching to actually it's a very, very similar way to pitching for sales. You're going to find the problems that your customer has through an initial sales call. Then you're going to go in and pitch, and you're going to tailor that pitch to make sure that your product solves all of their problems. And it's exactly the same with investors. Find out what they want, not what you want to tell them. So yeah, it's a good point. All right. So let's end it there. If any of you do want to follow up, like I say, the best way is to fill in go through the process of unpacking where you are with the investors, the pitch ready scorecard, and then you get the opportunity to jump into a more intimate session with me. And then we can have some one-to-ones and stuff afterwards, and that's probably the best next step for you if you want more information and want to start refining your pitch. But I'll leave it there, and thank you all for coming along. It's been absolutely great, and plenty more of these to come. So keep your eyes peeled. See you all later.
Thank you, James.
Bye.
Thank you, James. Well done. Thanks, man.